The perfect trade entry. World Cup Championships. Trader, choose and use this methodic to take the perfect trade entry. But you have to do it step by step. You have to understand what is the real rate to become from this step to the next step to the next step to find the real entry. We use the footprint charts, for example, to be able that we are on the real point going inside of the market. And also a lot of other things. You will be happy to listen to see this video because I explain everything how we choose in the World Cup Championships of Trading, and translated this video with AI because I'm not a perfect English speaker, I'm not a native English speaker, but I think you will love it. Thank you to see you.
Yes, let's be honest with each other. There are so many ways to make money in the capital markets, and there are so many endless strategies. The question is always, which of these strategies actually works? And I can tell you one thing, there's one thing that's extremely effective. You always have to be able to read where the global money is positioning itself and what kind of route planning you can derive from that. That applies to scalpers and it applies to position traders. It applies to breakout traders and it applies to counter traders. Each of these types of traders needs to understand exactly and pinpoint when their trading edge appears, when their setup comes into play. And if you don't do this correctly and don't pinpoint it properly, then the whole thing is doomed to fail from the very beginning. I can guarantee you that. Because believe me, I searched for so many years for an edge. And at the beginning, I didn't even understand that it can't be applied in all market phases. And today I know what kind of matrix I had to build, had to develop in order to always know what is relevant and when. And that's exactly what I want to show you today. So let's take a look at what we consider in our matrix at Trade the Traders. The first thing we look at here, for example, is a 15-minute chart. I also really like to use a 30-minute chart or even a daily chart to get an overview. An overview of the dynamics of the past few days so I can identify what's currently relevant. I look at whether the trends are substantial, meaning is there stability in them, or are they trends that lack substance and simply fall downward? These are already very different pieces of information which are extremely important to me to identify whether there is a foundation behind this trend. And when I see that there is a foundation behind a trend, then I also know that there is stability in it. But what is the next thing I have to do? That's step one. I determine whether the trend structure is healthy. You can analyze trend structures with higher highs, lower highs, and so on. Yes, it's relatively easy to look at them individually, but of course that's absolutely not enough. The next step I always take is to get an overview of the profiles in the weekly chart. So each profile here represents a week. If I can see that the big money, the big capital is really being driven by the global players right now, then I'm interested in continuing to follow this trend here. What I can also do here, and this is really fantastic, is that I can immediately see, for example, where there are so-called naked POCs, meaning untouched, untested, volume-weighted points of control. And that's a bit of technical jargon, but in the end, it's nothing more than the highest turnover of the underlying weeks. And what you can also see, of course, if you familiarize yourself a bit with market profile, is that I can see where the so-called single print areas are. These are areas where large market participants have hammered their orders into the market very quickly. And these price areas show me that there was simply aggressive buying there on a large time frame. And something like this always happens when market participants have to do it, when there's a logic behind it. And as you can see very clearly here, down here there were very, very aggressive purchases. Then after that, the market kept moving upwards. And when I see something like that, then I know, okay. So down here, the market started to establish a trend very aggressively. And this trend is upward. But now I see here this trend is downward, and that's a contradiction. So I have to examine this contradiction and clearly look for where I can find intelligent levels in order to possibly enter a long trade again. Or from when is it over? And that's exactly what we're going to do together now and take a look at it. So we have the result that on one hand we're falling down, but on the other hand, the larger market structure tells me that we're actually rising steadily. So now we have a situation that we first call a pullback. And the big money, where is it playing? I can pinpoint that very clearly here because I've had several large volumes here where the market in this weekly profile indicated that fair prices are shifting upwards. In the next step, of course, I look at how things are behaving at the top. And I can see, and this is what's exciting and crucial here, that there is aggressive selling happening. And that's exactly what I see here, of course. And when I see whether there is aggressive selling, I need a target area. And I can define these target areas, for example, using value areas, naked POCs, or old single print zones. But that's not rocket science at first. What's much more important is being able to recognize whether the market is activating these price areas. Will it accept them when it goes down so that I can establish a long trade for myself at these price areas again? And for that, I move on to the next step. Then I use the corresponding smaller time frames and the daily, that is intraday profiles, to locate my so-called support and resistance zones. Yes, and I do that exactly the same way as here. Here I consider where in these old profiles the major market participants entered and from which point the probability is high that the trading volume will drop off. And this way I can clearly identify for myself, all right, this profile here was very bullish. And if the market moves into this profile, then I'll see if I can get a long trade there. I can just as well approach it the way it is right now. The market is already below this profile. And I can look for where my next reaction level is. And here, for example, we have another nice naked POC. A naked POC isn't an edge in itself, but rather it's an indication for me that there was aggressive trading there, or in other words, that a lot of traders played their game there, and so we have a fair price area here. This profile was aggressive for the simple reason that a strong trend developed afterwards. And if we think back to the cumulative delta, then we should take a look at what the trading volume was like here. Was it really dominated by strong buyers, or maybe it wasn't? That's the next step we should take. So in the next step, we take a look to see whether these price areas that I've marked here, when the market reaches them, give me reactions. Let's do this as an example, just like that. And now, if the market comes down here, let's assume we move from here down to here, and this would be this price area from here. And we have the information from the higher level trend that everything is still currently oriented to the long side. So what should we be looking for here? Here we should examine whether the market is actually willing to start buying again. And then we have an edge. Why? Because we have the first piece of information from the higher level time frame. We are oriented to the long side. We have the second piece of information from the intraday area, where we can say smart support and resistance level, which was formed by big money. The footprints of the global players, that's all we can look at. And once we've considered that for ourselves, we move on to the third point, our major setup. That's what, unfortunately, is very often touted as a strategy. And this setup needs to show us that actual buying is taking place. Because just imagine the following. If someone says the market is coming down here and I make a prior assumption that the market should be bullish, I pick a smart price area where I expect a reaction. And now for my part, I enter here, a breakout setup to the downside, because I've learned that I should always trade breakout setups. That makes absolutely no sense. So you absolutely need to know which setups you're looking for and at which points. And only when the market, for example, has crashed below here and makes a pullback, or even if it doesn't make a pullback, then I'm allowed to look for a breakout setup to trade a quick, accelerated move to the next price area. And unfortunately, this is done wrong very often. What does that mean in plain terms? In plain terms, it means, first of all, it is crucial to always consider the broader global money supply and its intricate movements. Second, it is equally important to always look for intelligent, well-informed, and insightful perspectives. Logical, support and resistance areas. Third, before making any crucial decisions, and then carefully and thoughtfully select which setup should appear there. And then you have an advantage in the market. And that's exactly what almost nobody does correctly, unfortunately. Because very often people say, I have a great strategy, for example, an inside bar. And this inside bar is a technical level after a trend. Let's say it appears here now. So, and now I've learned that if this inside bar is broken to the downside, then I should go short. That's what is very often taught. But what's missing? What's missing is, first of all, power. Whether these setups even fit my current trend structure. Second, and this is extremely important and is always misinterpreted, and big experienced traders don't typically do this. Is this particular setup positioned at a truly smart, significant support or resistance level where the major influential market participants also genuinely want to establish a clear and decisive trend reversal? And if you haven't clarified these two questions, then with a setup, without the corresponding context, you will never be able to make money consistently. That's why backtesting such setups usually doesn't work. You would always have to do the backtesting only when you previously placed the setups at the right points, where the market should turn, or at the points where an accelerated trend should occur. And I am convinced 99.9% that this is an edge if you take these points above to heart for yourself. And if you do that, then in the final step you will find out. And right now we arrive at this ultimate possibility, which every aspiring and experienced trader should carefully establish and deeply consider which specific trading strategy truly matches my unique personality and individual temperament. Because here too, I can tell you very clearly and with absolute certainty, I honestly don't know any truly long-term, profitable and consistently successful trader who, for example, patiently waits for such significant market breakouts if he is actually someone who is incredibly patient and possesses a calm, disciplined demeanor. At the precise moment when the market suddenly makes a critical decision, press the button, it's truly starting, he simply won't be quick and sufficiently decisive enough to actually do it. That means you have to choose the right strategy for yourself so that once you understand the matrix, you can clearly pre-select where it actually makes sense for you and your personality to trade. And there are clearly 4 different ways to do this. And these ways are relatively easy to interpret. First, there is the path of the so-called swing traders. These are the patient ones who trade from support to support, and they are usually both counter-trend and trend continuation traders. That's very often the case because these guys are patient and they understand the law of large numbers. Then, secondly, there are the people who always want to trade only in the direction of the trend because they love it, to go with the big flow. They have to pre-select whether a market is currently even in such a trend phase. And of course, they should only use setups where it makes sense for them. The third group are the people who are always against things at first. You probably know them. There are people like that, who are always against things at first, who fundamentally question everything. And these people should definitely do one thing: they should engage in counter trading. And that means they need to be able to pre-select where a counter trade actually makes sense for them at the moment. And once they've made that selection, they can apply it accordingly for themselves. And these counter traders, above all, need one thing: patience. Because when a market comes up from below and turns, it always takes some time before the trend. gets going. And now, fourthly, there are the scalpers. These are the ones who really trade in a highly dynamic way. And these scalpers, they have their own definition of trading. And I'll show you that very briefly. This image that you see here right now is nothing other than the raw commodity market. These are all order books, and these books, they move fast. These books give you all the information you need to be able to trade the markets short-term and precisely. And yes, that's simply the fourth type. I always call them the avatars of traders, who feel at home there and can read the order books incredibly well. And believe me, in the institutional sector, selection is very precise. Who is suitable for which trading purposes? And then the corresponding trading areas are assigned to the personalities. And then everything runs smoothly. I hope this was helpful for you. I enjoyed explaining this to you, and it will be great once you establish these simplest building blocks for yourselves.